At first glance, what corporate America is doing right now doesn't seem to make much sense. Companies are spending hundreds of billions of dollars while interest rates remain higher than they were just a few years ago. Technology giants continue building data centers at record speed. Manufacturers are opening new factories. Utilities are investing in power infrastructure. Businesses across nearly every industry are increasing capital spending. If economic uncertainty still exists, why are so many companies investing even more aggressively? It sounds contradictory. Shouldn't businesses be cutting costs instead? That's exactly why this trend has confused so many people. But once you see the numbers behind it, the entire picture changes. And suddenly what looks like risky spending starts looking like one of the most logical business strategies in years. Here's why. For decades, businesses judge success using familiar numbers. Revenue growth, profit margins, market share, customer acquisition, those metrics still matter. But over the last few years, another number has quietly become just as important. Productivity, not simply how much money a company earns, but how much value it creates with every employee, every dollar invested, and every hour worked. That shift is changing corporate decision-making across America. Imagine two companies with identical annual revenue. Both generate $10 billion. Both employ roughly the same number of people. From the outside, they appear nearly identical. But one company has invested heavily in automation, cloud computing, advanced software, and modern digital systems. Its employees complete routine tasks faster. Customer service responds more quickly. Products reach the market sooner. Operations require fewer manual processes. The second company still relies on older systems. Work takes longer. Costs remain higher. Decision-making moves more slowly. Over time, those differences become enormous. One company gradually becomes more profitable without dramatically increasing sales. The other struggles just to maintain its position. That's the power of productivity. And it's one of the biggest reasons businesses continue investing despite economic uncertainty. Now consider another number. Artificial intelligence is increasing demand for computing power at a pace few industries have experienced before. Every AI application relies on enormous amounts of processing capacity. Every new business tool requires cloud infrastructure. Every digital service depends on servers operating around the clock. That's one reason technology companies continue investing billions into new data centers. At first glance, the spending appears extraordinary. But demand for computing capacity has been growing so rapidly that companies believe waiting could become even more expensive. That's another number changing executive decision-making. Then there's electricity. Modern computing infrastructure consumes tremendous amounts of energy. Utilities across the United States are planning billions of dollars in new investments because they expect electricity demand to continue increasing over the coming years. Power companies don't make decisions based on headlines. They make them using long-term forecasts. And many of those forecasts suggest the American economy will require significantly more electricity than it does today. That changes how businesses think about infrastructure. Semiconductors tell a similar story. Every advanced AI model, every cloud platform, every modern data center, every high-performance computing system depends on increasingly sophisticated chips. Demand has become so strong that governments and private companies continue investing billions into expanding semiconductor manufacturing. Again, the spending seems enormous until you understand the numbers driving it. Demand continues rising faster than supply. Labor tells another interesting story. People often assume technology reduces the need for workers, but that's only part of the picture. Businesses still need software developers, cybersecurity specialists, electrical engineers, project managers, AI researchers, construction professionals, network architects. In many cases, technology changes the types of jobs companies need rather than eliminating the need for skilled employees altogether. That's why businesses continue investing in workforce development alongside digital transformation. The numbers support that decision. Then there are customers. Consumer expectations continue increasing every year. People expect faster deliveries, better digital experiences, instant support, reliable online services. Companies that fail to meet those expectations often lose customers to businesses that can. Executives understand this. They're investing because the numbers show customer loyalty increasingly depends on convenience, speed, and reliability. History helps explain what's happening today. Every major business transformation looked expensive at first. Railroads required enormous investment before connecting the country. The interstate highway system transformed commerce, but demanded decades of construction. The internet required billions in telecommunications infrastructure before online businesses became mainstream. Cloud computing initially appeared costly compared to traditional software, yet each investment ultimately supported entirely new industries. Today's infrastructure boom follows a remarkably similar pattern, except instead of highways and railroads, companies are building digital infrastructure, data centers, fiber networks, power systems, semiconductor factories, cloud platforms, artificial intelligence capabilities. Together, they form the foundation for tomorrow's economy. Wall Street understands this better than many people realize. Investors don't simply study quarterly profits. They watch capital spending, infrastructure investment, technology adoption, research and development. Why? Because those numbers often reveal where executives believe future growth will come from. Businesses rarely spend billions preparing for markets they don't expect to exist. Of course, not every investment will succeed. Some projects won't deliver expected returns. Some technologies will evolve differently than anticipated. Some companies will spend too aggressively. Others will move too cautiously. That's normal during periods of rapid economic transformation. But the broader trend remains difficult to ignore. Businesses across multiple industries are reaching remarkably similar conclusions. Computing demand will continue growing. Electricity demand will continue rising. Digital infrastructure will become increasingly valuable. Productivity will matter more than ever. And companies that invest early may gain advantages that become difficult for competitors to overcome. Those aren't decisions driven by optimism alone. They're driven by numbers. Numbers collected from customer behavior, infrastructure demand, energy consumption, technology adoption, capital investment, and long-term economic forecasts. Once you understand those numbers, something interesting happens. The current business landscape no longer looks irrational. It starts looking remarkably consistent. The spending isn't random. The investments aren't isolated. They're connected pieces of a much larger transformation that's reshaping corporate America from the ground up. So the next time you hear about another billion-dollar data center, another semiconductor factory, another major infrastructure project, or another company increasing technology spending, remember this. Individually, those announcements may seem difficult to explain, but together the numbers tell a very different story. They reveal a business trend that only makes sense once you step back and look at the bigger picture. And according to many of America's largest companies, that bigger picture is only just beginning.